Shanghai just closed silver at $104. The Western price right now is $90. Same metal, same moment. Two completely different planets. One of these prices is lying to you. And I'm going to show you exactly which one. Because what happened in the last 48 hours inside the silver market is not a rally. It is not a technical breakout. It is the first moment where the system that has been holding the paper price back is visibly starting to crack under the weight of everything it has been ignoring. Let me hit you with the numbers first. All of them. Right now. Because each one by itself is significant. Together, they are something else entirely. Silver just broke 90.96 in the West. Up over 4% in a single session. Breaking through the resistance wall that stopped every rally for 3 straight weeks. Shanghai futures closed at $104. Shanghai spot closed at $100. A $10 premium that has not closed. It has widened. COMEX registered inventory is at 87.2 million ounces. Open interest entering March settlement in 48 hours is 115 million ounces. This number should not exist. There's not enough silver in the vault to settle the contracts written against it. 71 million ounces rolled from March to May yesterday, the largest single-day roll in recent memory. The system survived this month, but surviving is not fixing. And May is coming. 25 trading groups were suspended by the Shanghai Futures Exchange in February alone. 25 in 1 month. Palladium closed up 4.5% today. Platinum closed up 7%. The entire precious metals complex moving simultaneously. The gold-silver ratio just broke below its 50-day moving average for the first time in months. Silver is outperforming gold, and gold is at 5,190. Every single one of those numbers is telling you the same thing. The price you are looking at in the West is not the real price. It is the delayed price. The physical market already moved. The gap is now starting to close. Let me show you what each of these numbers actually means, because this is where it stops making sense on the surface and starts making complete sense underneath. Start with the number that breaks the math. 87.2 million ounces. That is what COMEX has in registered inventory right now. The physical silver sitting in exchange-approved vaults, backing every futures contract in the system, 115 million ounces. That is the open interest entering March settlement in 48 hours. Do that math yourself. 87.2 million available. 115 million owed. If even a fraction of the remaining open interest demands physical delivery instead of rolling or cash settling, the numbers do not balance. This is not supposed to happen in a functioning market. A futures exchange is supposed to have enough physical metal to honor its delivery obligations. COMEX is sitting 28 million ounces short of that requirement right now. And that is before accounting for the fact that registered inventory inside those vaults is not evenly distributed. Some shorts face delivery pressure even when aggregate numbers look manageable on the surface. Now here's what happened yesterday that you need to understand before I show you why it does not solve anything. 71 million ounces rolled from the March contract to May. The largest single-day roll we have seen in this entire cycle. Positions that were supposed to be settled with physical silver in the next 48 hours chose to move to May instead. The system survived this month. But here is what the roll did not fix. It did not add a single ounce to COMEX registered inventory. The vault is still at 87.2 million ounces. The drain that took COMEX from 167 million ounces 4 months ago to 87.2 million today did not stop. It did not slow. Nothing about the 71 million ounce roll replenished 1 ounce of physical silver. The pressure valve worked, but the pressure is still building because May settlement arrives in less than 90 days with the exact same structural math. The same drain, the same constraints, the same Shanghai premium pulling physical metal east before it can replenish Western vaults. Now let me show you what is happening inside Shanghai, because this is the piece that changes everything. The Shanghai Futures Exchange suspended 25 trading groups in February alone. 25 separate accounts, all in 1 month. The official published reason from the exchange is that accounts exceeded daily opening limits and violated exchange trading rules. That is the regulatory language. Here's what it actually means. Someone was pushing size aggressively inside the Shanghai silver market, not retail speculation. 25 separate groups large enough to breach position limits that trigger mandatory exchange intervention. And the SHFE issued a margin adjustment notice yesterday, February 24th. Raising margin requirements on silver contracts. The exchange is actively working to reduce leverage in a market it sees as dangerously stretched. Now think about what that combination tells you. 25 suspensions, a margin increase, both happening simultaneously. While Shanghai futures close at $104 and the Western price sits at $90. The exchange cracked down on speculation, hard, and the $10 premium exists despite the crackdown, which means it is not being driven by leveraged speculation. It is being driven by something the exchange cannot suspend. Real physical demand for real physical silver that the market cannot satisfy at Western prices. The physical market in Shanghai has already moved. The paper price in the West has not caught up yet. And look at what happened across the entire complex today to understand who is driving this move. Palladium up 4.5%, platinum up 7.03%, silver up 4.19%, gold holding above 5,190. That is not a silver story. That is a precious metals complex rotation. Institutional money moving into the entire category simultaneously, not picking individual metals, making a sector call. When institutions rotate into a sector, they buy everything in it, all at once, because they are not making metal-specific decisions. They are making a macro decision that the sector is moving. And silver, the most suppressed relative to its fundamentals of any metal in the complex, is the one with the most room to run when that rotation hits. Because institutions arriving late to silver find a market where the physical is already constrained. The Shanghai premium is already elevated. The COMEX inventory is at a 75% collapse from 2020 levels. And the technical structure just broke through a resistance wall that held for 3 straight weeks. All of those conditions existed before today. Today confirmed that institutional money has decided to move. Now let me show you what the gold-silver ratio is telling you right now, because this signal is flashing something that the paper price at $90 is not reflecting yet. The GSR sits at 57.06 right now, down from 59.16 yesterday, breaking back below its 50-day moving average for the first time in months. When the GSR breaks below that moving average and holds, it means one thing: silver is outperforming gold on a sustained basis, not a one-day spike, a trend that historically runs for weeks and months once it establishes. Gold is at $5,190. At a GSR of 50, which is the historical average this ratio has repeatedly returned to, silver at a 50-to-1 ratio against 5,990 gold is $103.80. The current price of silver in Shanghai today. Gold is already pricing silver at $104. The West is at $90. You are watching 2 markets price the same metal completely differently in real time. And the gap between them is not random noise. It is the distance between where the paper price is and where the physical market has already gone. Silver's own 50-day moving average sits at $81. Silver is trading at $90, 96 cars, $10 above its own rising moving average. And that moving average has not declined since May 30th of last year. A sustained uptrend, not a corrective bounce, a trend with structural legs. Now here is the technical picture that matters. And I want to be clear about what it is telling you and what it is not. Silver has been rejected at the $89 to $91 zone repeatedly since early February. Every attempt to push through got sold. Every rally got capped. The market pressed against the same ceiling over and over. Today, that ceiling gave way. Silver pushed through $90 with a confirmed close above resistance. It ran to $91.14 intraday. It is now consolidating above the breakout zone. The former resistance is the new support. The next objective from here is $92. But here is what the chart does not tell you. The reason the ceiling broke today is not technical. The chart is confirming what the physical market has been building toward. The catalyst was real. Trump signed a new 15% global tariff escalation last Friday. U.S.-Iran nuclear talks are resuming Thursday, creating fresh geopolitical premium. And the March settlement pressure that has been building all month finally cleared enough energy through the 71 million ounce roll to let the market focus on what it had been ignoring. The $10 Shanghai premium, the 25 SHFE suspensions, the GSR breaking its 50 DMA, the institutional rotation across the entire complex, the math that does not balance at $90 when Shanghai is paying $104. All of that converged today. And the ceiling broke. Now, let me put this in the context that makes today's move meaningful beyond just a daily price action event, because this is where the short-term numbers connect to the long-term structure. The Silver Institute published their 2026 market forecast last week. The freshest data available anywhere, 6th consecutive year of structural supply deficit confirmed. The world has consumed more silver than it mines for 6 straight years. The cumulative drawdown from above-ground stockpiles between 2021 and 2025 has been over 800 million ounces. An entire year of global mine production, gone from inventory, not coming back. That was the structural baseline before today's price action. Now add what is happening to supply right now. Mexico, the world's largest silver producer, is operating under conditions materially worse than 12 months ago. Transportation insurance for refined silver bars in key producing regions is currently unobtainable. Vizsla Silver's world-class Panuco deposit remains suspended following worker abductions and deaths in January. The CJNG succession war following El Mencho's death on February 22nd is 3 days old with no resolution in sight. China classified silver as a strategic material, export licenses restricted to 44 approved companies. 60 to 70% of global refined silver supply, the processed metal that industrial manufacturers need, is being rationed. Not sold freely, rationed. And Samsung locked up 100% of the La Paria mine's output for 2 full years through a direct prepayment deal, not buying on the open market, not hedging through futures, going directly to the source, because the boardroom decision was clear. We cannot trust the market to supply our silver anymore. Every ounce that moves through private channels like the Samsung deal is one less ounce available to replenish COMEX. And COMEX is already at 87.2 million ounces with 115 million in open interest. This is not supposed to happen, and yet here we are. Now let me go back to January 29th, because understanding what happened then is essential to understanding what is happening right now. Silver hit $121.67, its all-time nominal high. Then on January 30th, COMEX engineered a 30% crash in a single session, the fastest silver crash in modern market history. Treasury Secretary Besant went on television and attributed the move to speculative excess by Chinese traders. The crash did exactly what it was designed to do. It shook out the leveraged longs, reset positioning, bought time for the physical delivery problem building toward a March crisis, and it worked, temporarily. But here's what the crash did not fix. It did not add 1 ounce to COMEX registered inventory. It did not slow the structural deficit entering its 6th year. It did not stop the Shanghai premium from reestablishing itself. It did not reopen Mexican supply chains. It did not reverse China's export restrictions. The crash was a pressure valve, not a solution. And today, with silver at 90.96 and a confirmed breakout from 3 weeks of base building, the market is saying something clear. The pressure that was released in January has rebuilt. The structural forces were never resolved. They were deferred. January's high was a spike. Spikes retrace. Today's move is a base breakout. Base breakouts build. That distinction is everything. A spike happens when leverage momentum chases price into an unsupported high. COMEX brings it down. Positions get washed. Price retraces the entire move. A base breakout happens when price consolidates for weeks, shakes out the weak hands through repeated rejection at resistance, builds a foundation of real buyers at the support level, and then finally breaks through with the structural forces still fully intact underneath. 3 weeks of consolidation between $70 and $91. 3 weeks of resistance at $89 to $91. 3 weeks of the physical market in Shanghai holding a $10 premium above Western prices throughout. 3 weeks of COMEX registered inventory continuing to drain. 3 weeks of the GSR compressing. 3 weeks of institutional accumulation across the complex. That is the base. Today is the breakout from that base. I want to give you the full, honest, bearish argument, because this story has large claims and you deserve to hear the complete picture. The 71 million ounce roll yesterday demonstrates that the immediate March delivery crisis has been largely managed. Most positions chose to roll forward rather than demand physical. The COMEX system for this month held together. Some analysts argue this is evidence of normal market functionality rather than stress, that when participants voluntarily roll, the system is working as intended. The Shanghai premium, while elevated at $10, has narrowed significantly from the peak of $34 per ounce after the January 30th crash. Some observers point to that narrowing as evidence that the worst physical dislocations are behind us. And the GSR at 57, while breaking below its 50-day moving average, is still significantly above the historical average of 50 and far from the extreme compressed readings that marked the peak of previous silver outperformance cycles. These are honest points. They explain why the ceiling on this move may be lower than the most extreme scenarios suggest. But here is what the bears cannot answer. The 71 million ounce roll resolved March. It did not add 1 ounce to registered inventory. May settlement arrives in less than 90 days with the same structural math. Same drain, same supply constraints, same Shanghai premium pulling metal east. The $10 premium is narrowed from $34, but it is not closed. Every single day it remains positive, the arbitrage continues. Physical silver keeps flowing east, Western vaults keep draining. The GSR at 57 breaking below its 50 DMA is a directional signal, not a destination. The direction is silver outperforming gold. That direction has historical precedent for running significantly further once it establishes. And COMEX at 87.2 million ounces, down 75% from 2020, with no replenishment visible on any timeline, is the number that makes every bear argument a temporary argument rather than a structural one. The bears explain why the worst case may not fully materialize. They do not explain why the risk that has already materialized at documented measurable levels is priced at $90 while Shanghai pays $104. Here is exactly what you watch from this point forward. Watch whether silver holds $90 on a daily close basis. Today's intraday breakout needs to confirm on the daily close. A close above $90 means the breakout is real. A close back below $90 means the resistance needs another attempt. If $90 holds as support, the path to $92 is open. If $92 breaks, the $100 psychological level comes into view. Watch the GSR daily. It sits at 57.006 right now. Each point lower means silver is outperforming gold by that ratio compression. Watch whether it sustains its move below the 50-day moving average or whether it reverts. Sustained breakdown below the 50 DMA is the trend confirmation signal. A GSR pushing toward 50 against gold at 5,190 is silver pushing toward $104. Watch COMEX registered inventory. With March settlement in 48 hours, watch whether the 87.2 million ounce figure holds or accelerates its drain. Any acceleration post-settlement tells you that the structural outflow has not paused. It has only slowed temporarily for the roll. Watch the Shanghai premium. If the $10 gap widens rather than narrows as Western prices push toward $92 and beyond, it means Chinese physical demand is absorbing Western price increases in real time. A widening premium at higher Western prices is the single most bullish signal this market can produce. Watch SHFE enforcement notices. The exchange publishes suspension actions publicly. If March sees another wave of suspensions at the scale of February's 25, the aggressive physical accumulation pressure inside Shanghai has not eased. It has intensified. Here's the thing I keep coming back to after building this video. The price you are looking at in the West is not the price the physical market is paying. Shanghai is at $104. The insurance market refused to write coverage for Mexican silver transport. Samsung bypassed COMEX entirely and bought a mine directly. The Silver Institute confirmed 800 million ounces drained from above-ground stockpiles over 5 years. The sixth deficit year starts now. The system held together this month. The pressure valve worked. But the pressure is still building. The drain continues. The premium persists. The deficit accelerates. And today, for the first time in 3 weeks, the Western paper market stepped above the wall that has been holding it back. The base held, the wall broke. And the gap between $90 and $104 just got a little smaller. It is not closed yet, but it is moving in one direction, and it has been moving in that direction every single day since January 30th while the paper price was consolidating. The physical market already moved. The paper price is catching up. $90 is not the price. It is the delay. If you want this analysis, every time a number like today's hits the public record before the mainstream makes sense of it, subscribe and hit the bell. This is not information that comes packaged with a press release explaining why it matters. Everything I showed you is publicly verifiable right now. Pull any of it, verify all of it, then look at $104 in Shanghai and $90 in the West. One of them is the real price. The other one is running out of time to catch up. If this breakdown gave you clarity, subscribe. I'll keep bringing you the signals before they become obvious.